Hi, I'm here again with another episode of investment, which is the introduction of stock investing. So, firstly, what you need to understand about stock is that stock is a type of security or financial instrument that gives an individual or the trader or the investor the access to own a share of ownership in a company. What I meant is when you have Apple as one of the top companies in the world, can have it's possible for them to have their share price to be at $310.20. So this means that an individual or a stockbroker or a stockholder can buy 1 unit of Apple shares for this price. So you can get more than that if you want, depending on your risk decision or your return decision. So the key things to know about investing in the stock market, let me say, is that you need to be able to simplify what you really want in the stock market. What do you want to really achieve in the stock investing? So most traders just want to grow their money. They want to grow their money. They want to invest in something that could give them a long-term returns. They want to accumulate wealth, let me say, or probably it could be retirement reasons. So you just imagine Mr. A gets $50 per annum, $50,000 per annum, and at the end of the day, at the end of his maybe currently his age is 25 years old, so he get paid with $50,000 per annum, and it just occurred to his mind okay, let me just have a comfortable retirement plan for myself and for my children, maybe to fund my children's school fees, my children education and all. And he thought about himself retiring in the next 35 years. So he's retiring in the next 35 years. All things being equal, that means the job is secured. Let's say primarily the job is secured. So if he is retiring in the next 35 years, at the end of the 35 years, it's going to be his age is going to be 60 years old. Meaning, when he's 60 years old, he wants to know how much he must have made from any investment that must have given him some returns, maybe some long-term returns or some short-term returns. So typically, generating income or generating returns from stock investing needs to be in a long-term position. That means you don't need to invest for a short period. Like you don't need to invest for 1 month to 3 months. If you really want to enjoy investment, you need something in years. So you need more than 3 years to 6 years to have a good track record of whatever your return must have been during that period. So the key reasons why most people want to invest in a stock market is you want to preserve your capital, you want to grow your capital, your retirement plans, because when companies sell their shares to shareholders, the shareholders also have the access to be able to resell those shares at whatever price it might be in the future. So it's just like a fractional ownership or a percentage ownership of an organization's equity. So In stock investing, there are needs for you to determine how long you want to invest. Like I said, um, if Mr. A is 25 years old now and his retirement age is 60 years. So time horizon, let me say, time horizon of investment is 35 years. So that means from age 25, he wants to invest, or he wants to keep investing $10,000 per annum. Okay, he wants to keep investing $10,000 per annum in the stock market. So that's the precise objective of Mr. A. You understand? So he's trying to accumulate a certain amount of return when he's this age, when he's 60 years. So now, investing the $10,000 in stock market, it goes a long way, and this means that you being considerate of putting out $10,000 per annum in an investment box or in an investment pool can give rise to ups and downs, which could definitely affect the $10,000. And the time value of money, the principle of money is that $1 today can never be the same without $1 tomorrow. So it means that $1 today is definitely going to change. So the $10,000 today is definitely going to change. It's going to change with the purchasing power of that money per a dollar. So an investor needs to be pretty sure of the exact amount he or she wants to put in an investment. So, and you have to adapt to such type of thing, such type of what's it called, lifestyle of investing. So by the time you determine how much you want to invest, how much you want to lose, how much you feel you could get, this is just arbitrary reasons for investment. I can say, okay, I don't want to lose from my $10,000. I don't want to lose more than 10%. Okay, I don't want to lose more than 20%. Now, you don't want to lose more than 10%, you don't want to lose more than 20%. All gives rise to the risks of you losing your money. So when it comes to the return, you can say you don't want to lose more than, you want to earn up to, now you say you want to earn up to 15%, or you want to earn up to 25% for your return. Now, just like I say, like the time value of money, the market dynamics, the market sentiment, the news we see on the TV, the trends, the patterns of different type of companies that in the stock market affect all the amount of percentage you don't want to lose, or you want to lose, or you want to make in the market. So the volatility, that means the trends, the patterns, the upward and the downward of the $10,000 is not fixed, because it changes. It changes with the growth of the company. It changes with the responding moves of the company. Okay, so without having a basic or a solid foundation of investing, you should know that your $10,000 today can give you $50,000 tomorrow, can give you $9,000 tomorrow. The meaning of this is just solely behind the rules that say the time value of money, that the $1 today is not the same with $1 of tomorrow. So what do you need to know before investing? What you need to know before investing is you need to determine your sources of income. Okay. Mr. A is 25 years old, is retiring at the age of 60 years. His time horizon of investment is 35 years, and he wants to invest $10,000 per annum. Now, all things being equal, meaning like his source of income is assured, right? Like it's fixed. So we are sure like for the next 60 years, we're going to have $10,000. Okay. So another basic thing you need to know about investing in stock exchanges or the stock market is that before you put out an amount of money, there's need for an emergency fund or there's need for a liquid fund. The liquid fund is meant to be in an account that can take care of you and your family or take care of your basic needs for at least 6 months. Meaning, before Mr. A put out this amount of money in the stock market, he needs to be sure that, okay, I think there's tendency of me not having an amount of money I need at a certain time, but there's need for a liquid fund of at least 6 months. So after doing that, what Mr. A is currently doing or is doing at the moment is he's building up his risk tolerance to the changes that could happen in the market. So the expectation of returns or the expectation of profit from the stock exchange can be hampered and can grow depending on government policies, the law of demand and supply. Okay, government policies, government changes, the law of demand and supply, competition. There's competition amongst firms, among companies, the trading in the same line of trading in similar industries. So you can have competition as well. Yeah. So, and there are some other like reasons that could affect your investment. So, risking an amount of $10,000 in an investment for a period of 35 years is definitely a good decision, if you may ask me, because you might not be able to figure out your investment style till you get it like from the year 1 to year 2 to year 3 to year 4 to year 5. So if I'm Mr. A, hypothetically, let me say, Mr. A invests 10,000 units of Apple shares at $300. This makes the total sum of shares to be 300. 1, 2, 3, to be $3 million. So that's for year 1. Year 2, without increasing the number of units, okay? Without increasing the number of units. Year 2, the 10,000 units of Apple shares it's definitely gonna be not gonna be the same. It can increase and it can also drop. I assure you that. Let's say 310. Let's say 340. So it's 340. One, two, three. 1, 2, 3. So this means that Mr. A has been able to, oh, sorry, it's wrong. This means that Mr. A has been able to increase his total amount of his shares, like the share amount, to $3.4 million just within 2 years. So it's the price is just what's going to determine the quantity of what this amount is going to be. The price is a sole contributor, a sole determinant of shares. So it can shoot up and it can also drop down, just so you know. So the other things you need to know about investing in stock exchange is that you can keep your money in the stock exchange market and just ignore it for years, and apart from you increasing your wealth, you are also entitled to dividend, because Apple is definitely going to pay you dividend per share you are holding. A dividend is just a compensation of thanking you for holding their shares. Apple is going to thank you for holding their shares for that period of time. So they can say, they can tell you $20 for 1 unit of shares. $20 for 1 unit of shares. So meaning that Mr. A, who had 10,000 units in year 1 and 10,000 units in the same year 2, is entitled to $200,000 bonus. It's just like the dividend. You can call this dividend, you can call this bonus. That is due to the shareholder. So when you had 3400, 1, 2, 3, 200, 1, 2, 3, 1, 2, 3, 6, 1, 2, 3. So in a single year, the dividend is still going to like increase your share amount by $200. So in my next video, I'm gonna put out an Excel sheet of this explanation so that you could get it very clearly. Thank you so much for your time. See you again.